Good afternoon, everybody. Welcome today. Here we are, Monday, 10th of September 2018. And here we are for what I think is our 7th session now in the Mastering the 4 M's of Trading webinar series for Admiral Markets. For those of you who don't know me, I'm Paul Wallace. I'm a trader, analyst, and coach. And we are going to talk through this session, as we have done for the last few weeks, about mastering the 4 M's of trading. As always, I'm just going to quickly begin with a quick risk disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 83% of retail investor accounts lose money when trading CFDs with Admiral Markets UK. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please ensure you fully understand all risks involved. Forex and CFD trading is a risky activity, and this presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the author. The presentation and accompanying videos for information and educational purposes only. As of August 2018, the regulation within the European Union differs for retail and professional clients. In our presentation, we use demo trading accounts where all clients can still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with a maximum payout of 50,000 sterling as per our negative balance protection policy. Admiral Markets UK provide a wide range of products and services for both professional and retail clients. They offer some excellent offerings, in particular the DAX 30. They also provide the MetaTrader Supreme Edition for both MT4 and MT5, which is as a fine addition to the MetaTrader suite of platforms. If you have any questions about Admiral Markets or about the presentation or the offering, then please feel free to get in touch with your account representative, and they'll be very happy to discuss with you the options available. So, as I said, ladies and gentlemen, if you're joining us for the first time, my name's Paul Wallace. Okay, I'm going to talk a little bit about my own trading here on this slide. I describe myself as a discretionary based method trader. If you're completely new to trading, don't really know what that means, I assure you, if you join us during this series, you will learn from that, week by week, what that actually implies. Primarily, I consider myself to be a dominant trend swing trader. So trades opening for a few hours to a few days, maybe to a few weeks. I'm very, very big on simplicity, okay, because you're either a fear-based trader or a greed-based trader. I know that I'm a fear-based trader, and I know that simplicity is key for me, and you'll see that throughout all of the elements that we cover over the next few weeks and months, that actually that simplicity seeps into how I go about my business. I like to mix fundamentals, technical sentiment, and geopolitics, okay, to build a picture, but I would suggest that, it's primarily technicals that I use for my execution, and that's what we'll be talking a lot about over the next few weeks and months. Primarily, my focus is on FX indices and commodities, but I will also look at, cryptos and equities. I don't do a massive amount on fixed income, occasionally a few trades on the bund, but that's about it. But, what I'm going to be talking about, I like to think of them as being sort of a time frame and instrument agnostic in terms of the concepts and ideas that we'll share together. In FX markets, my philosophy is very simple. All right, I'm looking to buy strength and sell weakness. That's what I'm looking to do. That's what allows me to sort of effectively ride those dominant trends. I particularly like to use pullbacks for entries, and that's one of the things that we the main focus of last week's session. And we'll do a little quick recap of it this week. But as I go through the session, we'll talk more about pullbacks, but we'll also talk about breakouts as well. What I like to do is I like to focus on picture building on weekly charts. That's what I like. I try to build and understand what the strength, trend, and momentum is. Then I look to execute and manage on daily and 4-hour charts, all right, and just using very simple price action techniques for my entry. As I said, primarily a discretionary-based method trader for swing trading, but I will also do some intraday trading, and in that I'm actually a mean reversion trader. So I like price to extend. I like for it to get overextended, and as it rolls back towards the mean, that's where I'm looking to take my intraday trade, and that's something we'll touch upon, in a good few sessions time. So there you go. That gives you a little bit of insight into how I operate, and give you a little bit of an idea about, the sort of the ideas and the concepts and what I'm going to talk about as we go through mastering the 4Ms. As always, I just like to set the expectations that it's my job here to educate you about the 4Ms, and that's what I'll be doing. I want you to be able to go away and begin to analyze any market and be ready to trade it. That's what I'm hoping that you'll be in a position to do. And also what I'll do is, as I expand on the concepts and ideas, hopefully I will be raising your self-awareness about about managing risk, and also about managing yourself. For yourselves, ladies and gentlemen, as I say every week, I appreciate, we have 45 minutes, so there's a little bit of a time limitation on there, so it limits me a little bit of the breadth and the depth of topics that I can always go into, because I do understand we have a broad range of experience in the room. I appreciate there's some people who are trading just brand new to trading markets, and others who have been with us for many years, and so I try to give a little bit to cover all of them, but I would ask for your I'll ask for your sort of forgiveness if I can't cover all of the topics to the sort of the breadth and depth that you would like. So with that kind of limitation, I always try and focus on tools that you can use tomorrow. I want you to be able to look at these slides, and whether you're joining us today or whether you're watching us in on demand, and in the future on the Admiral Markets Facebook or YouTube channel, I want you to be able to just take a couple of the ideas and go and have a look at charts next day, and start to see how you could fit that and build that into your existing, let's call it like trading operation plan. That's what I'm very big on, just keeping it simple, so that you can actually sort of take away and utilize it and find out whether some of the ideas and concepts I share with you, whether it actually fits in with your way of working, whether it helps develop you as a trader. So I'm sure I appreciate that some of us you've been joining me for many of the sessions. The whole thing about mastering the 4Ms of trading is really it's all been about my experience as a trader for myself, as a trader for funds, from working with traders from who are complete beginners through to traders who are exceptionally experienced professional traders, and working for institutions. Is that what I learned and realized is that it's the traders who were doing well they had complete mastery of the 4Ms of trading: markets, method, money, and myself. If you're joining us for the first session, I can recommend that you go back to session 1, okay, which will be available in the archive. And during that, I went into each of those 4Ms in a little bit more detail about what they actually made up and what we were looking at. But really, as I said, what I found was that traders who were who were in control of those 4Ms, who were mastered them, who had a good handle on them, okay, they were operating in a little sweet spot that allowed them to trade with consistent success. And so if you're having a little struggle or a challenge in your own trading, which everybody does, okay, everybody does from time to time for various reasons, okay. If you're having a little challenge or struggle, well then, it's time to just have a little look at, take a little recap, or take a little review of how you are doing in terms of mastering those 4Ms of trading. Because I can assure you, even if you're having a little challenge, the issue will be in one of those particular 4Ms. And I'm hoping that during this series of webinars, I'll be able to start to sort of educate a little bit about, how you can sort of look at those 4 areas, what they're made up of, what the things you can personally do to help you, develop and evolve as a trader, and also how to build your trading business as you go. And that's what all these sessions are about, okay, is, we always do a few slides, and then I try and finish off with a little bit on looking at the charts itself on the Admiral Markets MetaTrader Supreme Edition. But it's really about weaving those 4Ms together, starting to take, the sort of the ideas and concepts, and just weaving it all together into a way and a means that you can actually operate. That, as I said, you can switch on your charts tomorrow and actually start to, to sort of trade effectively. That's what I want for you. So, we talked for the last, 5-6 sessions really about the understanding the markets. Okay, the first M was, I want to understand the market, right? And talking about, okay, how I want you to be able to effectively, understand the market you're trading, okay, and be able to understand, have almost like a small process, a small routine, a simple checklist that allows you to effectively operate effectively in any particular market. And what I was saying is about having some very simple steps that you can follow so that it becomes an almost automatic response, all right, in what you do. And we've talked about it over the last few sessions. Step 1, how you define levels of support resistance. Step 2, you define if there's a trend. 3, you look to see how price reacts at key support resistance levels. Step 4, which is what we're going to edge in towards today, is about looking for price action signals at support and resistance levels. And 5, is it part of a bigger chart pattern? That'll be future sessions down the way. As I said, it's almost becomes automatic. It doesn't really matter what you trade, okay? Whether I know we'll have people here who are sort of traders on cryptocurrencies. We'll have people here who are 5-minute traders of euro dollars, others who will trade dailies on the DAX, etc. Doesn't really matter. As I said, I want it to be time frame and instrument agnostic. I want it to be able to sort of just have this routine that just helps you do the right thing time and time and time again and become consistent and disciplined in how you engage with markets. So if you remember, step 1, defining levels of support resistance. What I said is when you open a chart, look at the monthly, the weekly, and the daily chart, start to draw in horizontal levels of support and resistance. You can also use specific psychological round numbers that that are of relevance or interest to the market. So dollar index with 95 has been a very important psychological round number. Okay, 115 around that area there on euro dollar, 111, okay, about dollar yen. All right, 130 was around about a pound against dollar. Okay, so dollar Swiss franc parity, etc. It was all sorts of those kind of numbers that that it stands out. Okay, we also talked about for new traders you can use the fractal indicator, which is a very simple indicator, but that sometimes can help you sort of just work out where those particular levels and zones are in terms of where their importance are on the particular charts. Step 2, okay, remember we talked about, well, when you're looking at a chart, you want to define, is there a trend in place? We're going to start, okay, the start of this webinar series, we're going to start, as I said, a little bit about being sort of trend following traders. As we go on, I'll start to add in areas around about things like understanding reversals, about, when we look at the intraday element, about doing some mean reversion. But realistically, at the moment, what I'm looking at is about, we want to just define, is there a trend? All right, and I need to know that you, as a trader, that you can identify whether an instrument is trending or consolidating. I say it every week, okay? The good trends leap off the page at you. All right, then you don't have to fight to identify the trend. It will be quite evident to you. So I always put up this chart. The DAX weekly on the left hand side, you can see it's consolidating. On the right hand side, you can see it's in a nice uptrend, okay? And I just, as I said, I just need you to be able to sort of to show to me, all right, that you're in a position to be able to identify that, okay, and and know which is what market environment that your particular instrument that you're trading is in, okay? Just as I said, we just keep it simple to begin with. We also looked at about, we talked a few sessions back about, using moving averages as a very simple visual indicator. I talk about on my charts how I have the blue 20 period, the red 50, and the green 200. Simple moving averages. I don't really use them for crossovers. What I was saying is we use them to just, help with our identification of a trend, maybe give you also an idea a little bit of the sort of the speed and momentum with that trend, and also I particularly like them for areas of dynamic support and resistance, and I'll show you a little 1 or 2 examples of that if we have time at the end. And then, we talked about, right, okay, step 3 was, wait to see how price reacts at key support and resistance levels. And I talked about, what does that actually mean? It means, we're looking for a confluence of events, all right? Confluence of events to happen at key levels. And that is where we start to just to look at the things we're going to touch on today, all right, in terms of starting to include price action setups to maybe give us an opportunity to give us a trigger into the market. As I said, overall, we're looking at keeping it simple, okay, to begin with, all right, and what I want to do is to identify if there is a trend or if there's not, because when markets are bullish, I want to be a buyer. When markets are bearish, I want to be a seller. Sounds very simplistic, but week after week, time after time, I see people who forget that, okay, who forget that very, very simple but truism. All right, when markets are bullish, you want to be a buyer. When markets are bearish, you want to be a seller. All right, define the trend and trade with it. If if there's no trend, there's no trade. There's no signal, no trade. All right, I quite often sort of suggest to people you just take a screenshot of this page. Screenshot, print it off, stick it up there in front of you and on your trading wall. All right, with all the good things that just reminds you, okay, that just seeps into your mind through osmosis, day after day, week after week, month after month. All right, just reminding you to do the right things time and time and time again. And that's that's what part of this is. That's why every week I just have a little couple of slides on the recap, because I almost, as I said, I want it to become automatic for you. I want it to become, by the end of this series, that you can just almost like do this in your sleep. All right, I talk about when I was a young man, I was in the military, and as part of my role in the military, I had to carry a rifle, and they would train me until it became automatic, until I could actually strip the rifle, blindfolded, and actually put the rifle back together blindfolded. Okay, and they do that because actually that's what needs to happen. You need to be able to do that, wherever and whenever. And it's just a little bit the same with trading. Okay, it's almost like you need to have a little routine that you can follow to almost be able to do it, blindfolded. Okay, to know what you actually need to do. And that's what all of these sessions are about. Though they're about instilling that kind of fundamental routine in you, in how you operate in markets. So so there we go. We did step 1, we've done step 2, done step 3. Okay, and step 3 also included big round numbers, moving averages, horizontal support, resistance levels. So let's have a little bit of a look at some price action signals at those particular levels. That starts to get us a bit interested about what's possibly going on. And as I said, we focused mostly on markets, but the last week's session, we started to edge into method, and that's what we're going to be focusing on for the next few weeks. Okay, different types of methods to give you some sort of execution opportunities. That's what I'm very keen to touch upon. And with that in mind, what we're going to be focusing on, we'll be focusing on each week for the next sort of, let's say, the next sort of, at least 4 to 6 weeks. We'll be doing just a piece on one little execution. Okay, one little execution tactic that you can take away and use. All right, and I'm going to focus on the basic versions of them, okay, for the first 6 weeks. But then, when we come back in a few months' time, I'll start to sort of feed in some more advanced options for you. Okay, so stick with us as we go through, and we'll be able to sort of add these sessions, add to your trading knowledge as we go, ladies and gentlemen. So if you remember last week's session, and by all means, as I said, these are in the archive, so don't be afraid to join in. What I talked about is that we have thousands of trading and investing methods. All right, but effectively, really, for the most part, they all boil down to one of 2 particular styles. All right, your trading method, you're either trading a break of a line of support resistance, or you're trading a bounce off a line of support resistance. As simple as that. All right, now people make them complicated. People get all sorts of ideas and such, but actually, when you break it all down, that's what you're actually doing. You're either trading a break of a line, or you're trading a bounce off a line. All right, and it's about understanding which particular version works for you. All right, last week we did a good few slides on that. All right, and so by all means, come go back and check that. We put up a few slides. This is particularly one I always enjoy showing it, because it's the Kiwi dollar yen over on a weekly basis. So every candle is a week, and realistically, you can look there over a period of about 4.5 years. That Kiwi dollar yen, it was bouncing off 69, okay, on the resistance level, and bouncing off 58, okay, on the support level, right now. And it did that for about 4 years. Did that for about 4.5 years, until at the end, where we see on the right, it broke out of it eventually, okay. It broke out, and then that was the start of a new big trend. And it is about just, as I said, I wanting you to just very simply be able to identify when a market's trending, when a market's, in levels of support, when they're bouncing off levels of support, support or resistance, and about knowing whether you tend to be, you know, a breakout trader or a bounce off trader. There's nothing to say that you can't do both, okay? But what you will find is by, you know, keeping records of your trading and reviewing that, you'll start to realize where you have a particular edge yourself, all right? Maybe you are a better breakout trader, you know, maybe you're a better bounce trader. I personally, I like to trade bounces, okay? You know, I can understand that, but you know, I will trade, you know, occasional breakouts, but you know, it's almost like sort of 85% of my trades will be bounce off trades. That's the way I particularly like to operate. So, you know, what I talked about was, you know, really it's about, they both have pros and cons, all right? Some people prefer breakouts, some people prefer bounces. I say all the time, I personally prefer bounces as part of a pullback in a trend, because it gives me, and the reason is because it gives me an opportunity to enter a better price, all right? And also, if I'm going to be wrong, I know I'm wrong far sooner, which might sound strange, might sound a little, you know, maybe not what, you know, people were thinking about, but you know, the truth of the matter is, your trades, you know, not all of your trades are going to be right, okay? As much as you may wish them to be, the reality is that, you know, you're going to get trades wrong. And personally, if I'm going to be wrong on a trade, I'd sooner know I'm wrong as soon as possible, because if it's as soon as possible, then I can get out of the trade. I can, you know, save my capital. Okay, I can also save my emotional capital as well. Okay, there's nothing worse than sitting in a trade for, you know, for hours, days, weeks, not knowing whether it's going to work for you or not, whether it's going to actually, you know, whether it's going to go profitable or not, because the market is just literally just, you know, just sort of going back and forth. If you're going to be wrong, find out you're wrong as quick as possible, so that you can just get out of the trade, save your capital, and then move on to the next trade without it sort of draining you of your emotional capital also. And that's a subject matter which we'll touch upon, you know, a good deal more in the next few sessions when we kind of move down towards the kind of the 4Ms of managing myself. So let's talk about one particular market method that we can use to sort of give us an execution, right? So price has, you know, we've identified levels of support and resistance. We've identified the market is, you know, either trending or maybe it's consolidating. And, you know, what we're looking at is, you know, once price gets to particular levels of interest, we want to see, well, what's it going to do when it gets there? And one of the very simple, you know, we're starting with a very simple pattern, okay, that traders use and traders can see is something that's called a pin bar. Sometimes it's called a rejection candle. Sometimes you might hear it called, you know, a high test or a low test bar. Okay. Sometimes you might hear it, you know, by Japanese terms. Okay, so things like shooting stars. The reality is that it's you know, it looks like, you know, I call it a pin bar, okay, because it comes from it looks a bit like a pin, but also it is effectively like an insight into the sort of from the Disney character Pinocchio. All right, those of you who are of a certain age, shall we say, might remember that. Okay, might remember Pinocchio, and if you remember Pinocchio, whenever he lied, his nose got taller or bigger and bigger. And a pin bar is like that because it's telling you a lie. Okay, whether the pin, whether the wick is pointing to, okay, is lying, you know, about the market direction, because what you'll find is very often the market will go in the other direction. Okay, it's lying to you. It's, you know, it's rejecting the direction that it had been going in beforehand. It's a very frequent pattern. And what it does do is help us, give us great indications of supply and demand, and it's very clear and easy and visual to see on charts. Lots of people will trade them, but not all like me. And as I said, today I'm just going to go through the sort of basic ways to identify and trade it. But in months' time, as we come back and as we evolve from being, you know, just basic traders to being more intermediate and advanced traders, I will give you more intermediate and advanced ways to enter it. But for today, I just want you to sort of, you know, to understand, be able to identify them and start to work with them. Okay, so when you see a pin bar here, and I'm just going to hopefully sort of try and use the drawing tools on this wonderful piece of kit we have here. So you know what I'm looking at here is, you know, there's just drawing in. There's a couple of pin bars there, right? In the markets, I see the tails, okay, which are these wicks here. So let's say, I'm going to apologize just in the sense that, ladies and gentlemen, I am a much better trader than I am an artist. So I ask you to just forgive me and tolerate my woeful artistry, okay, on the charts. As I said, I'm a better trader than I am an artist. But what I'm pointing at there is, when I see in those markets, I see big tails like that. Okay, I see that as it's the most likely indication of where big predators are lurking in the market, where big order blocks are sat waiting to be worked through. And in those pin bars, okay, those tails, that shows a rejection of a particular area or a particular direction. Now, as a private trader, on let's say on the sort of the swing basis, longer term basis, okay, just in a normal trading environment, as a private trader, it's pointless to try and fight them, all right? Don't try and fight them, okay? What we want to do is actually we want to work with them to show the likely short-term direction. We want to sort of try and utilize them to help us, give us a trade entry opportunity. Okay. So here's what we have as a couple of ideas about what we're looking for and what we need in terms of a pin bar, right? So a pin bar, it must have, let's use this, let's try and use this drawing tool again, okay? A pin bar must have the open and close within the previous bar's range. Okay, so it's here was its open, here was its close. They are within the range, okay, of the previous bar. What we also like to see is that the wick is, the wick is, here we go, as I said, excuse my artistry. We always want the wick to be 2 to 3 times the length of the body, okay? We like to see a nice, a nice big wick there, okay? Ideally, we also want to see the long nose, okay, protruding from all other. There's exceptions to that, but as a general rule, we want to see them, we want to see it sticking out there. Let me get rid of all that drawings there. And as I said, the better pin bars that they stick out on the very visual, and we'll have a look at that in a moment, okay? We'll just pull up a few charts and have a particular look at that, okay? But as I said, if you're completely new to trading and you're not really sure what a pin bar is, once again, I'd just say take a screenshot of that chart, okay, of this page, stick it up on your wall, okay, stick it up on your wall, all right, and just if you need it, if you're completely new. The reality is it actually doesn't take a great deal to start to learn to identify pin bars. You see on a chart they're actually a very frequent pattern. The challenge people have is that new traders try and trade all of them, and that's never a terribly effective way to go about business. What we're looking to do here is we're looking to sort of combine a few things together. Remember what I was saying in sort of step 3, it's about a confluence of events. I'm looking for a confluence of events, and we'll talk a little bit more about that in a couple of slides time. So once again, these are examples of bullish pin bars. Okay, what I want to see is that what I want to see is if it's bullish. So here we go. I'm expecting that I'm expecting the next direction is probably price has come down, and I'm expecting price to actually sort of move up here. All right. First 4, okay, I really like. We've got some good size wicks. Okay, you can see we've got good size wicks. Now the wick on this one isn't isn't as great. It should be 2 to 3 times, but what I like about it is that we've had an open and we've had a very, very, very strong bullish close there. Okay, think about who is in control of that market. Who's in control of that market. When that market closes, who's in control of it? It's most definitely the bulls. So I'm happy to do it. Whereas this one, okay, what we're seeing is the wick is very small. We opened here, we pushed down, we came back, we closed here. Okay, and it's not really the sort of the bears are still in control. The bulls really haven't had the strength to wrestle control. So for that, no, we don't like that. We don't like that per se. Bearish examples, well, not unsurprisingly, it's the opposite. So we'd probably be expecting that market might be moving up, okay, and we'd be waiting for it to give us an idea that the next push would be down. Remember, okay, the nose is lying to us; it's pointing in the wrong direction, okay. So same as the other ones, okay. We've got some nice wicks, okay, nice bodies there, right, okay. This one, I'd like because effectively, we've opened here, we've pushed up, okay. and then price has collapsed and closed right down on its lows. Okay, it's a very bearish example. Okay, the bears are in control, whereas this one is a no-no. All right, because we've opened here, we've pushed up, okay, and we've closed. There is a wick there, but we've closed with the bulls still in control. That's not what we want. Okay, that's what we want. We want to see overwhelm of the market to give us an indication of where the next future direction is. So, safest way to trade a pin bar, okay, is where possible, all right, is that we're looking to effectively, we want to be trading them within an identified trend. So just drawing on here, we're expecting the trend is to go down, and then remember what I was saying, price pulls back, okay, it hits a level of dynamic resistance there off the 20-period moving average. We have a nice bearish pin bar, that's my terrible art, and then effectively price continues on its way down, okay, and that's the way I like to trade them, okay, within an identified trend on a pullback where it's bouncing off a particular support and resistance level. Remember what I was saying, it's all about having a confluence of events. It's, there is three things there coming together, 3 or 4 things all coming together at one point, and for me that gives me the right decision matrix to take a trade that I want to be short on that particular trade. Excuse me, I just take a sip of water just to keep the old throat there lubricated. Here's water. Okay, so for a pin bar, how do we enter? Today, as I said, I'm just going to share with you the kind of, call it like the original, the basic, the very simple way to do it. We'll come back to these in a few months' time, and I'll talk about more advanced levels and ways that I do it, just to help me with my reward to risk ratio. There are quite a lot of ways to enter pin bars, all right? But as I said, I just wanted to give you a simple standard one you can start to take away and use from tomorrow. That's the plan. And so safest way is in this case we've been in an uptrend. We've had a little bit of a pullback. We've got a nice pin bar showing up there. And what I'm going to be looking for is once price breaks the high of that candle, okay, if a few pips above it, that will be I'd be looking to place an order to take me long, okay, and then my stop loss would be at the beneath the other end of that candle. So depending upon your time frames, let's say this was a daily chart. As a general rule, okay, in a daily chart, I would be looking to sort of have my long entry probably 5 pips plus the spread above. My stop would be about 5 pips beneath the low. If this was, let's say, on a daily example, okay, and that's what I'd be looking to, and I'd build that into my trade plan, okay. So what we're waiting is that price has to actually trade higher, okay, for it to trigger our trade entry, okay, to take us in. And we also know that if for example price triggers up and then it falls down, okay, and goes this way, well then we are taken out here, okay, because our idea is wrong. Remember what I was saying, ladies and gentlemen, is if I'm going to be wrong, I want to learn as quick as possible. I want to know that my idea isn't going to work out, so that I can save my capital, save my mental energy, and then go and start hunting for the next opportunity. That's what I'm looking for. That's how I'm looking to operate, okay. And it's simple in the sense that I know exactly where I'm getting in, okay, for my entry, and I know exactly where I'm getting out when I'm wrong, okay. That's key for us, okay. You always want to know where exactly where your entries are and exactly where your exits are, okay. Keep it as simple as you possibly can. So Jack's just asked me a question. Do you place the order in advance? Preferably, Jack. So if I'm trading this on, let's say on a higher time frame, okay. So let's say it's something like the 4-hourly charts, daily charts, weekly charts, maybe even the monthly charts. You will have the opportunity to place a pending order in advance, and that's what I would suggest you do. If you're trading on, let's say, a smaller time frame, let's say that chart here was actually a 5-minute chart, okay, you might be required to enter at market just because of the nature of the market movement. So my preference is always to set a pending order and let the market come to me and take me in. But on the shorter time frames, that isn't always possible, and sometimes you'll have to enter at the actual market. Okay, so as I said, just be aware of your time frame. It's something we'll talk upon in a future session. But where possible, try to use a pending order. But sometimes that's just not possible. It's just the way the market's working. So, as a final point, remember what I was saying, pin bars, they're likely indicators where the biggest predators are lurking, where, the biggest order blocks are sat. So, they show rejection of a particular area or a particular direction. As a private trader, okay, especially in the longer time frames, it's pointless to try and fight them. Okay, don't think you can fight them and beat them and you know best. What I would say is work with them to show the likely short-term direction instead. Okay, work with them, use them as an indication that where we're going to go for on a trade, and ideally look to trade with the trend. And what I'd be saying is, in terms of, we know where we're getting in when where we want to enter. We know where we're getting out, we're wrong. And what we'll also do is, we're going to have a session in probably about 4 or 5 weeks time is about talking about, where we place our targets. Okay, how do we target? Do we have targets? Do we have trailing stops? I'm going to do that all in one particular session, ladies and gentlemen. Okay, to give you the options that are available, so that you can make a choice about where you wish to go. At the moment, okay, you'll hear me talk all the time about asymmetric reward to risk ratios. Okay, so if I'm risking, I don't know, £100, I want to make 200, 300, 400, 500. Okay, that's the way I like to look at trading. So 2, 3, 4, 5, 6, 8, 10 to 1 reward to risk ratios where possible. Okay, but as I said, we'll do a specific session on that in a good few weeks' time. Okay, about how that can work and how you can actually actively look to sort of to decide which is the best way for you to operate. So we'll just finish the last few minutes looking at our 4 M's of trading portfolio. Okay, remember what I talked about a few weeks is we're going to focus on in terms of FX, we'll focus on the dollar index because it's supremely important, and we'll look at the 28 other major pairs, the crossovers between them. That's what we'll look at. I'll say also looking about the major indices. So we've got the major American ones there: S&P, Dow, Nasdaq. Also looking at some of the major European and global ones, things like the FTSE, the DAX, the Nikkei, and even the Chinese A50. We can have a little look at some of the hard commodities, okay, oil, gold, silver, copper, the hards, okay, they call it because it's literally anything that has to be dug out of the ground. Or you can have the softs, which is normally the agricultural commodities, things like wheat, sugar, soybeans, cotton, cocoa, okay. If like me, from farming background, okay, it's always interesting to keep an eye on those the agri commodities. We'll also have a little look at a couple of the fangs, all right. So there's Facebook, Amazon, Apple, Netflix, Google. You might have your own personal favorites. We've had a look in the past at things like Twitter. We had a look at Tesla. I think we had a look at a few weeks back. Maybe we'll have another look at that, seeing as Mr. Musk has been in the news over the last few days. But also, we will have a little look at some of the crypto offerings that Admiral Markets bring to us. Okay, about Bitcoin, Ethereum, okay, Litecoin, Ripple, etc. We can have a little look at them. There's always interesting opportunities there. Okay, so you can start to build, and that's what I was saying is that the stuff I'm sharing with you here, it's all about being instrument and time frame agnostic. Okay, I know for new traders we're going to focus more on trading, swing trading time frames, so 4-hour daily weeklies. Okay, but the concepts are as effective on the 1 and 5 minute chart as they are on the longer term. It's about being versatile. Okay, that's what I want you to be a versatile trader by the end of this session, and I define a versatile trader as someone who can trade any instrument on any time frame in any direction. You should be able to have the skills to do that. So just before I switch across to the charts, all right, okay, it's the big picture recap. Remember to manage those 4 M's of trading: markets, method, money, and myself. All right, at the end of every week, just check in with yourself. Check in with yourself about how you did managing those 4 M's this week. Okay, are they all in alignment? Are you on top of all of them? Okay, if not, well then don't be surprised if you're having a little bit of a struggle, and just constantly monitor those 4 areas. You can always get better at monitoring those 4 areas. It's it's a way of evolving and growing as a trader. So if you have any questions, okay, I appreciate you might be watching this on on archive, or you might be watch this, but tomorrow you get up and have a few questions about what we've talked about. Well then, Don't be afraid to get in touch with your Admiral Markets account representative. You can contact them there. There's a London number 02077264003. You email them at hello@admiralmarkets.com. They've got the YouTube channel where these videos will be on, and also the Facebook channel as well that you can actually particularly join in. And so Jack's joined us from Chicago. Thanks very much, Jack. I appreciate the feedback. And if I just bear with me a few moments, what we'll do is I'll just switch across to the charts. We've got about 5-6 minutes left, so I'll just always try and just do have a look at just a couple of charts. Okay, just we're traders. We love looking at charts. Okay, just have a look at one or two things that perhaps might be showing up with what we're particularly sort of looked at or talking about in our session. So hopefully maybe you can see the sort of the chart there. Okay, that's what have I got up there? I've got a bit of silver up there. Okay, one of the hards. All right, so I was kind of interested to see this. This is a weekly chart, okay, and talked about. Okay, let me put my cursor on here. Talked about here. I've been talking about this in the for those of you who join us, okay, on the Tuesday mornings. Admiral also run the real-time daily trading ideas. I do the Tuesday morning, 10 o'clock London time, and I think I've touched upon this about how on a big picture we saw silver. Around about the 1550 level. Okay, we had levels of support here. Okay, hopefully you can see that. But then also on the on the higher end, we had almost like a descending triangle growing. We had effectively prices we were getting sort of lower highs constantly. All right, and actually what we saw was we saw this lovely move down here. Okay, clearly the downtrend accelerated. What I was kind of interested is that as we were working our way down here, okay, on the weekly chart, we had a very big kind of bearish pin bar here. I'm hoping you can see that now. Of course, this is the weekly chart, so it means it's a big old it's a big old candle, but it fits into that picture. Okay, it fits into that picture. You see, we already had that sort of kind of that trend line in place. Okay, we were noticing that we were getting lower highs. Okay, all the time. All right, and that that kind of 1550 area was acting as dynamic, was acting as static horizontal support. We got the sort of the pin bar there. Okay, and then we saw a really that was the sort of really push down. Okay, and even though we had what looked like a pin bar here, and sometimes people will use pin bars to sort of signify the end of a trend. Personally, as I said, I like to use them as pullbacks within an existing trend. That's what I particularly like to look at them. All right, that's I like to identify there. Yep, there's a downtrend happening there. The moving averages are scrappy, but they're all they're just sort of edging their ways down. Okay, and we pull up before we collapse into that there. Okay, so that was pretty pretty interesting to see. And let's have a look. What we've had is look at sort of some of the some of the other sort of charts that we've had sort of kind of moving around here. We've had some here we go. Excuse me there, just move that down there. Okay, so we excuse me. We had here's the weekly chart, okay, of this is the pound against the dollar. Let's just build a quick big picture. This was the Brexit, okay. So no apologies, that wasn't Brexit. Brexit was here. This was the flash crash. Then later on, okay, in sort of September, October, that kind of pushed us down there, okay, beneath the 120, flash back above, and then we had a couple of engulfing candles, which is what we'll be touching on next week, okay, and then we started to move up, and we started to put in basically higher lows here. Okay, let's just start to draw this. Okay, started to put in some higher lows here. Okay, we can see that happening there. Okay, each of the lows was higher, and then we came back here and whoops, what we had there was let's just draw in. We had in there, okay, we had a bullish pin bar, okay, that continued to do that, okay, to sort of before it moved up. We then had we had another one here, okay, price was pushing up, but here we go. Price was pushing up, but then invariably, it's whoops, just here we go. It put in another one here. Let me just some of this. And then we had more here, okay, as price moved on, and so we can see that we're starting to establish an uptrend. Of course, this is a weekly chart, okay, so it kind of takes its bit of a time, but what we're looking for is once we've established a trend, as I said, my particular ways are I'm looking to trade bounces, all right, and price keeps coming down here. Price keeps coming down to the sort of 20 period moving average and bouncing off, okay, come down, bouncing off, comes down here, okay, hangs around, but then actually uses a pinball to push itself up there, okay. And so we're looking there, that we've got the 20 period moving average, okay, this is providing us with some dynamic support. We can see that we're making higher highs, okay, higher lows, we're into a trend, and then we also get some pinballs to sort of be the last part of the pullback. So as I said, once again, it's effectively a case of utilizing the having 3 or 4 things coming together at one point that gives us the opportunity to sort of look at and take a particular a trade idea. So there you go, ladies and gentlemen. All right, as always, I try to cram in as much as I can for our 45 minutes. Hope you found that useful. Hope you found that interesting. Okay, so you go through the slides, if you're very new, start to just look at pinballs and look at there are lots of them on charts. You can probably look on that chart and probably find 50 of them, okay. But what we're trying to do is find it as part of our routine, part of a confluence of events, okay, of a few things coming together at one point that will actually allow us to give us a higher probability trade. So there you go, ladies and gentlemen. Thank you for joining me. Okay, we're back here next Monday. Okay, 4 o'clock every Monday London time. All right, I look forward to joining. We're going to be going on to another price action setup. Okay, next week we'll talk about. And for those of you who who are sort of trading more frequently, the Admiral Markets run the real-time daily trading ideas session for English-speaking clients. That's 10 o'clock London time every morning. I do the Tuesday one, and there's also some other very interesting speakers for the other slots for the week. And as I said, I wish you the very best of success in your own trading, ladies and gentlemen. And I look forward to speaking to you next week. Have a great week, and I'll see you next Monday. Thanks very much. Thank you, Phil. I appreciate that. Appreciate the feedback, guys. Thank you.